Welcome to the High Rise Podcast, presented by Headset, the leading data and analytics company for the cannabis industry.
Welcome back to the High Rise, a laid-back, a data-back conversation on all things cannabis, where we talk about U.S. MSOs, Canadian LPs, products, and market analysis through the lens of data. I am joined, as always, by Emily Paxhia of Poseidon.
Hi, everybody. Welcome to the High Rise.
And special guest today, Jamie Mendola, Head of Strategy and M&A at Air Wellness and board member at Glasshouse. Thanks for joining us, Jamie.
Great to be here.
Great. Well, lots to talk about today. I know we talked a lot about earnings last week, and I think we're gonna we'll bring up some of them in context. But the big headline today, as of recording, is that New Jersey's adult use rules have come out, which basically lays out what the framework's going to look like for New Jersey, which is, a state we're all waiting for to kind of see. And every new state is unique and interesting, and it's always interesting to kind of see how they're approaching it. I think some notable takeaways that I read into this is that sales will start within 6 months or 180 days. Any time between when they sign this and when it goes into effect needs to be within 180 days. So 6 months or less, which is pretty exciting. It seems like it's been a very long time coming. But 6 months will be here before we know it. They also have a number of different licensing categories, which are, as you can expect, cultivators, manufacturers, wholesalers, retailers, distributors, and a license specifically for delivery services. And then as far as licenses go, no cap, which is, pretty interesting to see how that'll play out in a market like New Jersey. So how do you guys feel about this and this framework? Is this the template? I feel like every new state comes out and it's like, is this the one? Is this the right one? Because they're all kind of pieced together. So any thoughts on how this is structured?
No, I mean, it seemed pretty down the fairway. I do think, the note about no cap is always something as an investor that you kind of take note of and try to play forward how that could play out. But I think we've seen this in other states. You've got like Michigan, Oregon, California. And then what you see are the jurisdictions creating framework around what they'll allow and accept. And so you can, for example, in California, as we've talked about on previous episodes, you almost have limited license markets within the market. So it'll be interesting to see what each local jurisdiction does. I do think because we're in New Jersey through a few of our investments, one of the things I think I saw was that the decision to block it from the jurisdiction is if they don't do it now, then they can't go back and do it. But if they do it now, they leave themselves the optionality to open it up in the future. So there may be more jurisdictions blocking this at the beginning than what we'd like to see, but just to create optionality for themselves, I wouldn't be surprised if we see that. So those are a couple of things just right off the top of my head that strike me about this.
Yeah, I think Emily's right. I think the local jurisdictions are going to play a very important role. I think this market is going to play out probably more similar to Massachusetts. We've already seen a bunch of jurisdictions opt out. I think zoning and real estate and availability of good retail locations is going to be tricky. But similar to New York, I think New York and New Jersey are taking a very pro-social equity role. And I think there'll be opportunities for a lot of different entrepreneurs and groups to get involved. That being said, I still think, given the original, dozen or so alternative treatment centers, which are vertical licenses, many of which are owned by MSOs, and Air is in the process of buying Garden State dispensaries, which should be closed shortly. I actually think that the MSOs are also equally well positioned because of both the head start and the ability to have large scale cultivation, as some of the newer licenses that come online are micro licenses or craft grows. So this isn't going to be the oligopoly forever, but I actually think it's a reasonable way for market structure to grow, to provide opportunities for everyone. And I think the ones that have been there early and have good businesses still have lots of opportunity for themselves and to play well with some of the other groups that aren't going to be vertical operators.
I didn't get to see, did New Jersey, if you opt out of having the licensed operators within your jurisdiction, are you also opting out of the benefits of the tax revenue for the state? Because we did that in California, and I think that actually has been encouraging jurisdictions to go forward with adult use in this later part of the lifetime of the industry at this point. I didn't get to see that.
I didn't catch that, or I'm not sure if it was actually has been finalized yet. Okay. I do think there might be some local tax benefits for the groups that host cannabis businesses, but I'm not sure about the sharing with the statewide taxes.
Yeah, that'll be interesting to see because that can be a carrot to dangle in front of the jurisdictions as they contemplate potentially opening. I mean, the timeline of this lines up with what I've been seeing, to your point, Jamie, the MSOs articulating is probably Q1 2022 is when we'll see this go. And so if we go 6 months forward, that puts us right about in there. I saw a weird note from Cantor I think it was Cantor this morning saying Q3 of 2022, but that didn't check out to me. So I don't know where that came from. It was in the review of TerraSen's Q. But anyway, I think this is pretty good. And I am pumped for New Jersey. You know, I think this is going to be a great market. And as I was spending time in New York for the past few weeks, I've been meeting a lot of folks from New Jersey. Actually, I know a lot of people in New Jersey too, and there is a definite culture and interest around cannabis. And I think it's going to be a great kind of first one of these big adult use states on the East Coast, besides Massachusetts, which is a pretty different kind of a market. But I'm pretty psyched.
Yeah, it'll be interesting to see how this how it plays out. You know, the existing medical dispensaries apparently will be able to apply for municipal approval, but they need to have enough supply available, which I think shouldn't be a problem, but we'll see. And then it does say that they are prioritizing licensing decisions on micro businesses in addition to social equity applicants. So maybe this is a good way to take a market and bring in, you know, some smaller groups. It's also cost less to license. It's actually pretty reasonable. You pay 20% of the fee at time of submitting the application and only 80%, the other 80% if it's approved. So you don't have a huge outlay cost. So those social equity applicants, micro businesses, you know, can get in for, you know, $500 to start. And then if it gets approved, I think it's about $2,000. So will be pretty interesting to see. I know every state seems to struggle, you know, with the social equity component. I think Massachusetts has done some clever stuff with the delivery model and prioritizing social equity there. And maybe, you know, New Jersey will do something similar because they have signaled that 3 licensing categories they'll prioritize to promote social equity. They didn't say exactly what 3 categories, but maybe delivery, given, you know, what's happened in Massachusetts, is a good model for that. So we'll see. You know, 6 months is not much time to wait. And just exciting to see that state finally come online. I feel like we've all been waiting a fair amount of time.
It'll be interesting to see if the cultivators, you know, can get up to speed ahead of the adult use launch, right? You certainly have some of the established, you know, private or public operators, that many of whom are going through expansions of their cultivation facility. But this has been a pretty small medical market, and particularly if you're having a wider net of available dispensary operators. Question is whether there's going to be supply, you know, for 100 stores or 200 stores or however many there ultimately will be.
I think the answer is no. It's like every new market, it seems to always be the case. It's like every time you think, okay, we'll have enough time, we know it's coming, we'll make enough supply, and it just always, demand seems to always outstrip supply. Maybe New Jersey will be the one exception to that, where it just is a perfect market out the gate. But it is surprising every time a new market launches. It's like, haven't we figured this out? I mean, we've got so many markets now that have gone online, but I know it's a nuanced, challenging problem for sure. But I would expect that, the supply won't be there.
It will also come down to the testing requirements and how that actually gets hammered out, because I think maybe some of the product that exists in that state today would not pass some of these stricter tests, just based on what I know in the market. But because they don't really have strict testing, right, Jamie? I don't think right now the testing requirements are very complicated, but we'll see. Maybe they'll leave it more open. Like California is so tough, but not surprising.
Yeah. Well, speaking of California, I want to talk a little bit about brands and some news. And one of the brands out of California originally that made some news was Cann. I know we've talked about Cann in the past, you know, and some of their recent news around distribution through Green Thumb or GTI and kind of moving outside of California. You know, I've had a chance to try it. It's a great product, well positioned, I think. And, you know, the beverage market, while a small percentage, you know, 1% to 2% of a given market sales from a category perspective, it's small, but I think brands like Cann will continue to grow that category, because when you look at the early beverages that came out, I mean, you still see it. You know, I just saw it recently in Seattle here. I mean, just they're everywhere, but 100 milligram, small bottles of cannabis that just aren't really designed for a casual consumption, mainstream consumer. I think Cann has done a good job of that. But they recently announced caffeinated beverages, which is pretty, I think, the first of its kind in market. I haven't seen a cannabis caffeinated beverage. And they also announced that Rosario Dawson is joining the board. And you may know Rosario Dawson, actress, but also a partner with Cory Booker, who's tied into the legislation. So very big advocate of cannabis legalization. How do we feel about this news? Is caffeinated beverages the next thing? Is this going to be the thing that unlocks beverages?
I mean, it's definitely a kind of a fresh. I mean, we've seen caffeinated beverages, right? There was a couple of them back in the day in California. Like there was a group that was doing a partnership with Ritual Coffee here in the Bay Area, and so there had been a little bit of this. But then I think they had to get through those early days of the cannabis regulations and rollout of the new program, and so I don't know how well that went. But yeah, it's interesting that Cann's taking this approach because we know caffeinated beverages obviously are a very hot category and interesting to think about what people seek out caffeine for. And sometimes I know I can't help but think about, a Red Bull and vodka. And I know Cann has been very out there about they're trying to kind of go head to head against alcohol in social settings. And so if you're looking for maybe more of that uplifting experience, maybe that's what they're going after. And the campaign was really fun and cute. I liked the way they're approaching it. But yeah, it's an interesting take. And I think we'll see where it goes next. I don't know. Jamie, what do you think?
Yeah, look, I think it's a natural form of evolution and product development. I mean, it certainly seems like it could provide a niche to the category. And I'm sure it's pretty low risk to try to see, what sticks. So I think innovation is important. And look, I think more broadly, as we think through the microdose THC market, yes, it is a pretty small percentage of the overall business today. But look at the spiked seltzer market in the alcohol business. That was a zero market 5 years ago, and it's probably close to $10 billion now. So consumers have demonstrated the interest to consume this type of taste profile, this type of a beverage. And I believe that this business is going to continue to grow and take share from alcohol. It's far healthier. There's far less sugar, far fewer calories. It's better for your body. And if you can provide a dose that's comfortable for newer entrants and newer cannabis consumers, that's a very comfortable experience for them. I think the 100 milligram drinks, right, that's going to go to some of the legacy cannabis consumers. But for newer people to the category, this is going to be people drinking a THC infused beverage at a barbecue or a party, as opposed to a traditional alcoholic drink. You have consumption lounges starting to open up across various parts of the country, and I'd be shocked if this doesn't represent a much bigger part of the cannabis market several years from now than where it is today.
Yeah, and you're absolutely right. It's like a format too that these new category consumers that are coming in they're used to a beverage, right? They can relate to that. They can relate to seltzers, and I think that transfer is a lot easier than going into the cannabis category and going and buying a 3.5 grams of flower, right? That's like a much harder thing to do. So totally agree. And the consumption lounge point as well. In consumption lounges, it's hard to allow smoking or vaping, right? Just because of smoking laws. And if beverages are available, and if you get fast onset time with some of these beverages and that kind of trend, fast onset technology we're seeing, it could very well be a much more social type experience, and just overall will grow the category. But it's great we have you, Jamie, because another headline this week that came out was around Cultivana and Air Wellness and the sale of Cultivana to Air Wellness. And Cultivana is a beverage producer. I believe, is it Massachusetts only right now?
Correct, yes.
Is that right? Yeah, that's great. So any comments on kind of like beverage category for Air and how you guys see it? It's kind of, I think we got kind of a sense from what you were saying about Cann, but do you see Cultivana as kind of fitting that model?
Yeah, so that's the name of the holding company. The beverage is branded under Levia, and they're right now by far the number one THC infused beverage in the state of Massachusetts, where Air also has a very strong wholesale and retail business. So we've had a longstanding relationship with them as a supplier. We've gotten to know them really well, and there's clearly going to be some synergies across distribution and production, in the state of Massachusetts. But the real opportunity is to roll out that beverage platform into several of our other states. So we're currently in 8 states. I think we have ambitions to continue to grow our footprint. And again, as we start harmonizing our retail and wholesale brands, and we're centering around Kind for flower and Origin for extracts, and some strong edible brands, we think Levia is going to be our beverage franchise across the country. And there's going to be multiple winners. I respect Cann and some of the other groups that have started out on the West Coast. But we think it's a 0-calorie drink. It's an infused sparkling water. It's a little less flavor profile, and they have a great product with very good fast onset time and a clean, drinkable finish. So I think it's right down the fairway of something that's going to have a strong addressable audience, and particularly reaches deeper into the non-heavy cannabis consumers. And hopefully that opens up the doors for our broader range of products over time. But we're bullish. We think it's the right team and the right product, and we're excited to help their journey to grow into a national beverage brand.
It's very cool. And that's something I want to talk about today. And we've touched on in the past is kind of brand strategy and how MSOs like Eaze see the world through brands. And every one of the leading MSOs, I think, have a little bit of a different strategy. With Eaze in your Q2 earnings, your CEO, Jonathan Sandelman, mentioned explicitly that your brands are in over 280 stores. And that's up 3 times year over year, not slowing down. And he called out Kind premium flower brand, called out Origin extracts, and did call out Levia on the beverages side. And so it would seem like Eaze is looking at, you mentioned you're in 8 states with a retail footprint. I imagine retail in all 8 states, retail.
All except for Ohio.
All except for Ohio. And so you're selling these brands. You're also wholesaling these brands. So
right.
Kind of building like a CPG arm. Do you see, is there a future where, companies like Eaze kind of focus on one, like take the CPG path, or focus on the retail path, kind of like what we'd see in a traditional vertical? Or do you think that cannabis is unique and it's just the way it's structured and the way these states have rolled out legalization, that there'll always be this kind of hybrid model?
Yeah, look, I think it's probably a little too early yet to sort of separate the brand arm from the vertical infrastructure arm, particularly in the East Coast and Midwest states, where a lot of times these licenses are attached and they're much more limited. And look, the challenge, and we've seen this across several of the California brands, being asset light is just a little too early, right? Mm-hmm. That's something you can do in mainstream beverages or pet food or organic foods, where you have a strong co-packer network and the cost of the raw ingredients are not overly high. But we've seen a bunch of brands run into trouble where quality, consistency, or pricing really blows up in their face, either in terms of the consumer proposition or their middle of the P&L is so ugly they can't live to see the other side. So I think 5 or 10 years from now, the story might be a little bit different. But I think for the next several years, it makes a lot of sense to have vertical infrastructure where you can control the quality, where you can control the costs, and where you can also leverage the wholesale and procurement relationships of your organizations. Because let's be honest, there's some level of horse trading shelf space, and it's no different than some alcohol and other things where they say, hey, you want my premier brand? We want you to take the full range of products. And if you're dealing with someone else who also has a strong brand presence, there's likely to be an opportunity to support them as well. So I think if you're solely a brand house without those advantages at retail or at cultivation, it can work, but it gets a lot trickier. And I think it can probably work a little bit better for some of the nichier categories where the cannabis cost as a percentage of the finished good isn't as high. So I think in flower it's difficult. I think in vapes and concentrates it's difficult. I think in edibles, or quite frankly even in beverages, you don't have to be tied to a cultivator because the THC costs are not massively huge as a percentage of your product costs. But you still struggle with the same level of quality and consistency. And as you're developing your consumer proposition and brand promise, you screw that up once or twice and it gets tricky. And even some of the most prominent brands that have tried to move from the West Coast eastward, I think have really struggled with their partners and the execution. It sounds great, but I think it's harder than people think.
Way harder. Brands are way harder than anybody has given them credit for. They will serve you up some real challenges along the way. But I think that the focus on infrastructure, especially around beverage, which is pretty complicated in terms of, and it's heavy, and it's just very different from the other form factors of cannabis. Think about how light the other form factors are. It's like you can, it's just so different. And I think that it really does matter to be able to think that through and play through on the logistics. And then one of the things, in listening to these analysts on the calls, I think they're going to start, I'm glad you brought up the shelf space discussion, Jamie, because I think the analysts are going to start trying to track the trends of your penetration into other brands of retailers and your sell-through data on those shelves in other retailers, and the ability to have the infrastructure to keep your products on the shelves in those other retailers. I mean, we all know that when you open new doors in new markets, it's even a struggle to keep your core categories on the shelves of your own products, let alone being able to distribute into the other doors. So I think those are going to be some next indicators of true progress in the industry and real brand building. So I'm interested to watch how this unfolds. But beverage has definitely been one of the CPG of our industry categories to watch, because it's been coming off of such a tiny consumer base, but it does seem to have some interesting trajectory. I mean, Sai, you get to see the data all the time, so you sit in an interesting seat there.
Yeah, certainly we see the data, but also anecdotally, I feel like it's people are very excited about it, and and for good reason. I think all the points that we've made thus far, it's got a lot of opportunity ahead. And I like what you're saying, Jamie, about the seltzer. When that first came around, there was a 0% market share, right? It was brand new. Now it's like, I think half the aisle, the beer aisle or whatever it is in grocery is seltzer, and every beer company has a seltzer. So yeah, I could see similar trends happening here, and similar to what Air did here with Levia. I could see other MSOs looking for who is that beverage or that edible that we can bring to other states. And you're absolutely right, it's hard. We've seen some of the early brands that have kind of licensed out their formulas, their branding to other, the license holders in those markets. And you see different products being available in different regions. And that's strange for consumers, I think, when they're like, maybe they go to Colorado and they see, these products, and then they go to California and it's a different set of products under the same brand. There's no consistency. And I think with groups like Air, when you guys have a footprint in eight regions, you can start to build that up where there's that consistency. If I'm in one market or another, maybe I see some of those same brands, and you guys control production of a lot of that, so the consumer knows, okay, well, it's be the same versus a very different experience, which is, it's so foreign to, I don't know, the consumer goods category. Like when you get a Coca-Cola in California or New York, it's the same. You're not going to tell a difference, but it's getting there with some of these brands. And I think the footprint that larger MSOs like Air have seem to help with that and accelerate that. And I think that's just good for the consumer.
Yeah, I think the other opportunity by being vertical, right, is you get such great consumer feedback and data from operating retail. And so we can see trends, we can get the anecdotal information from the bud tender conversations and whatnot. And, we'll have our kind of core brand platforms that we're operating, nationally. But then we'll also be kind of a fast fashion model to come up with local products that might fill voids. So in Massachusetts, we launched Wicked Sours, which was an edibles, brand playing on, a popular thing in Boston, Nantucket Nugs, right? These are things that were whiteboarded by the local management teams and were launched into products in a very short period of time. When you start hearing traditional CPG or sometimes even cannabis, people talking about product roadmaps where they're going to go from idea to a launch in like 12 to 18 months. Yes, there's sometimes compliance and packaging issues that you have to work through, but I think being able to be flexible while also creating some harmony and scale of leverage of having those national brands, I think the combination of those two is very impactful. Because the reality is there aren't that many brands that consumers come in and ask for. Mm-hmm. So as we look at our store shelves at retail, we might look at edibles and say, okay, great, consumers love Wild. In a lot of markets, they like Kiva or Wana. And then there's sort of a pretty far, fall off after that, but there's 50 different edible brands. And so at some point, why carry more than the top couple and then backfill with your own private label or sub brands or whatever. You charge a little bit of a discount to give consumers, some value for a product that's hopefully the same or pretty darn close to the same. And that's far better than carrying the tertiary, gummy brand that people wouldn't care if it said one label versus another. There are far more products than there are brands in this industry.
Yeah, that's for sure. I like that you guys have kind of local, like the Wicked, what was it? Wicked Edibles?
Wicked Sours.
Wicked Sours. I think it's pretty cool, like idea that you can do that. You go to places and you might want to try, like, I'll try the wine from this area. I'll try the craft beer from this area. But it's different brands, right? It's, maybe some of the craft beer has been purchased by AB InBev or something, but, generally it's like, they're their own brands, but to kind of under the Air umbrella and kind of know, okay, well, it's going to be the same quality, same consistency, but just maybe only unique here. That's pretty cool as a consumer to be able to, try that and go to different states that might have.
Yeah, look, and consumers are getting smarter, right? Like they're as these states come online and mature, like every other category, their flavor profiles get more nuanced. I mean, think about wine 20 years ago, where half the people couldn't tell the difference between the boxed wine and Joseph Phelps. And, over time, people mature and get more sophisticated and their palates get more nuanced. The same thing's going to happen in this category. And so that the other thing that we've been talking about more and more at Air is we really want to be the highest quality producer of cannabis flower at scale. And we've talked a lot about the quality being what's in the box, not what's just on the box. And look, we're catching up and we're going to roll out some new, branding. There's certainly other companies that are half a step ahead of us from that front. But culturally and the way that we run our organization, we really prioritize investment in the talent on cultivation and extraction. And we truly believe that we are, will there be a craft, producer of high quality weed in California that's better? Of course, because that's how the world works. But we really want to fill that, whatever Starbucks slot, right? Who does it really, really well with affordable luxury at scale, across a wide network of, retail and wholesale opportunities. And yes, there will be a blue bottle, right? And there will be Folgers. But I think that's the sweet spot that we're really going for. And we really spend a lot of time and resources on not just growing and being there in attractive states, but producing high quality products. And if you look at the Reddit reviews and other things that people are going to, I would say that our feedback on our products and our flower, especially in some of the newer markets, that is as good as anyone else out there. And that's something that is very important from the top down at our organization. Yeah,
that's good to hear. So I want to talk a little bit about, since you're head of strategy, one strategy that kind of came out this week, the news that Eaze, known as a delivery company out of California, that signaled transition to ambitions to become a multi-state operator, an MSO, and have recently acquired Green Dragon with a pretty sizable footprint in Colorado and a few shops in Florida. They're also moving into Michigan in some capacity. So this I thought was kind of interesting. They're a tech. They call themselves a technology-based, delivery-focused company. Moving into maybe more traditional retail. Do you think it's easier? I mean, how do you both feel about this transition? Is it going to be easy for Eaze to transition into traditional retail, or do you think it'd be easier as a traditional retailer to transition into a delivery structure?
Neither.
Hard all the way around.
Neither transition is easy. I mean, the core businesses could not be more. I just, from being sitting, ringside to watching all of these operators function with these retail assets. I mean, there's nothing easy about it. It's complicated. It's competitive, even if you're in a limited license market, but you're dealing with so many different challenges that you probably can't understand unless you've spent time in it. And it comes from every angle. And Jamie is definitely a person to speak more about this than me, but I just think it's really different. Technology platforms function really differently. You have different challenges and different benefits versus having an operating business. But I mean, Green Dragon is a very well-established chain in a strong market, and it could be a really strong foothold for them. But I would definitely want to understand. I was just talking to some folks who are investors, and they were like, well, what's this going to mean for my investment in Eaze? It seems very different. And I said, well, yeah, you're now in an MSO, and you have to think about what that's going to look like from every angle in terms of the growth trajectory of the business and all of the different aspects of it. So it couldn't be more different than a tech platform at this point.
Yeah, I agree. It's going to be interesting to see culturally and operationally how this mashes up. Now, I do applaud Eaze, right? Like they were on their deathbed 18 months ago, right? And they would have never made it if they had not moved to a vertical model. There was just simply not enough economics in the model to be running without being the licensed operator and getting the full margin. So I do think that was an important pivot in the state of California. Now, moving into other markets, we'll see. Delivery is pretty nascent across this industry, almost with the exception of California. I might be missing a market or two, but it is not a very large piece of the overall pie. And just prior to the podcast, we were talking about some of the challenges with respect to delivery. But typically in most markets, you can't operate what I call at least the ice cream truck model, which is to have a suitcase of cannabis products in the trunk of the car that is routed to the closest to the consumer in the car and match them up. So if you have to go out and back, even if you're batching some of those deliveries, last mile fulfillment, whether it's cannabis or otherwise, is tough. Like you think about some of the Uber, Lyft, Grubhub, Instacart, most of them are very well-funded technology platforms with $1 billion of venture capital behind them. I can't think of too many that actually make money, right? It's a difficult business. You need to have a lot of scale and a lot of density. And so it makes sense to me strategically that this is the only way that it could possibly work.
Right.
But I'll be interested to see how it plays out. It's hard to believe delivery will be as small as it is in most states 5 years from now. So I think they're being forward-looking. But there's some challenges around having to be home when you take the delivery as opposed to Amazon dropping the product off at your porch. There's some real compliance issues. Certain states you have to have 2 drivers. You have to have separate inventory. It's tricky. Eaze has a brand name and they've spent a lot of money on consumer acquisition, which is very expensive for brick and mortar retailers to truly launch a large scale delivery business. It's one thing to service your existing customer base with delivery. That's not that hard. We all have our databases and we can text people and you can tell them at the stores that delivery is available. And it's not that hard to build a small little delivery business. But we've all seen 50 different delivery companies come into California, drop $5 or $10 million on customer acquisition, give them 30 or 40% off, and then they just pop to the next one, the next order. The retention and the lifetime value of some of these customer relationships has been very challenging. And so I'm sure there will be a couple winners. I think the Eaze new management team has done a good job. And, I think everyone will be interested to follow how this plays out.
Yeah. No, all great points. I could see this kind of being, it's their story. Of course, this is the brand that they've built, has been on delivery, but maybe they just start to look more like an MSO and not so much of a delivery platform today. And then maybe as delivery expands, that changes. And you're right. I think California, certainly has delivery, and there's some stuff happening with direct to consumer. But in other states, it's pretty new. Like Massachusetts is pretty new, that they're just kind of getting that going. In Washington State and Seattle, here where I'm at, we still don't have delivery. It's still not permitted. So, and even Colorado, where Green Dragon is, I think it's pretty early. I think Denver, some neighborhoods around there have started licensing delivery. I saw some announcements today through Starbuds, Schwazi, who's doing some delivery announcements. So it's early. So I have a feeling they'll look more like a traditional MSO for the time being, but maybe able to bring some of what they have to accelerate some of the delivery, but less of a delivery first type business in the near term.
I will say, just to share, one of the way that Eaze has gone after market share really aggressively is to be a deeply discounted platform. The things you can buy on there are way cheaper than what you can buy in the stores. And so now that they're moving into brick and mortar, and you can't do it because you're just going to be underwater. So it's just different. So I'm curious to see how they're going to approach pricing going forward. they have to start thinking about the actual management of that square footage and understanding that. So,
I mean, the other tricky thing, putting your investor hat on, is tech platforms and MSO platforms are evaluated differently and sometimes valued differently. And I think that's one of the reasons why it took Eaze so long to pivot, because it was a non-plant touching business backed by somewhat more traditional venture capital. And they all had to, I think there's some nuances of investors that could or couldn't be plant touching. But, tech companies can operate break even or at a loss and then sell 5 years down the line for a big number. And I think MSOs, the market's matured the last couple of years, and they're generally valued off of EBITDA. Not the only metric, but I think that's the predominant metric by which MSOs are valued these days. And particularly when you're in new market growth mode, I think the flywheel effect of most network effect tech businesses are that you're supposed to be spending back on customer acquisition and marketing to build market share and scale, because that's the way to win over the long term. Mm-hmm. But it's not the most optimal market to maximize EBITDA. It's the long game. And so that's the tension point. And, we've all seen this in tech, right? Where, I don't know, Comcast or a telecom company decides to go buy a software company or something that's a little bit higher growth. And there, tends to be different objectives and agendas. And hopefully all those folks are on the same page, because I think to maximize the value of Eaze is not necessarily synonymous with maximizing EBITDA or maybe the value of a brick and mortar franchise. So we'll see. There's a lot of complicating factors, but I think strategically it's very interesting. Yeah,
and you're right. Like they kind of saved themselves with this move. So kudos to them for doing it. We'll see how it pans out. Let's shift gears real quickly to Canada. Well, I guess the U.S. as well. The U.S. is the topic. So Tilray made some big news yesterday with their Medmen investment. This kind of reminds me of long ago cannabis growth and acreage and kind of buying in with the hopes of future, federal legalization, and this will be our footprint. Medmen, I thought, was a unique one. I don't really know the reason behind it, but certainly the price is right. I think that they came in at a pretty bargain rate to get this. You guys have any thoughts on this structure?
The way I feel about this is we continue to see these structures put in place because everybody wants to get a piece of the U.S. market, and it's for a good reason. So you have to kind of work through these different structures to be able to set it up for the future of this industry. But I mean, that's just my take on it, is that you can only build so much in Canada and kind of on the option of Europe, but Europe's moving at a totally different pace. And so the US is really the big prize. So that's what I see here, is it's just another bullish sentiment on the US.
Yeah, look, I think you're going to, as Emily said, the interest level from parties that can't invest in the U.S., whether it's traditional investment funds, whether it's CPG companies, whether it's Canadian LPs, it continues to be very, very high, notwithstanding some of the price action across, the space over the last several months. And, I think there's a lot of lawyers and bankers and others doing a lot of work trying to figure out what the appropriate and legal ways for them to deploy capital, and particularly fresh capital, into companies that allow them to grow. So the last two deals, right, we saw Cronos invest in PharmaCann. They bought a 10% stake, but the proceeds from Cronos went to pay a special distribution or return on capital to PharmaCann. It didn't go into the company. And similarly with Medmen, my understanding is that Tilray basically gave stock to the existing bondholders of Medmen in exchange for stepping into their position in the converts. So there's still not a perfectly elegant solution, at least yet, for those companies to deploy growth capital into a US MSO. And I think if a big CPG company or the Canadian LPs could find a way to do that, I think that would be the most natural way to truly get exposure to the higher quality MSOs that I think a lot of folks would be looking to shoot for.
Yeah, and that could be a driver for why Medmen in this announcement. Do we think that it's going to be? I mean, Canopy made that investment acreage so long ago, and still haven't been able to really capture any of that. Are we just waiting for federal legalization? There was a tweet that was floating around on Twitter from back in May, I think early, maybe Q1 earnings on Canopy, and Cantor Fitzgerald made a comment around, hey, there could be a path for Canopy Growth to, make these investments, and act on it and still be listed on U.S. exchanges. It's just a matter of working with the exchanges.
Yep.
And, what you see happening with companies like Weedmaps, I think, Graham Farrar also called it out on Twitter on that thread about, hey, this is a company that makes 100% of their revenue based on, cannabis companies. So the cannabis companies are their advertisers and paying them, but the NASDAQ got comfortable with that, right? Their revenue base is coming from cannabis operators. And, is there, timing wise, is there some hope, or is it just, hey, we're just going to keep waiting and just wait for some federal change, and at least we have some chips on the table, and maybe there'll be some event that happens, or maybe we get lucky with the exchanges, but end of the day, we're just going to wait for federal change?
I mean, I know there have been lots of conversations happening with the exchanges, both in the U.S. and in Canada, right? You have the TSX that I believe people have had some conversations with that may involve some of those. Maybe it's a secondary LPs delisting in the U.S. and moving a listing up there. Obviously, the holy grail would be to be allowed to be listed on the NASDAQ or the New York Stock Exchange with U.S. plant-touching exposure. In theory, that could happen before federal legalization. I think these exchanges are fairly, risk-averse, but they also realize that these are real companies. There's a lot of capital markets activity. Investors want, the access. But there's a lot of lawyers and compliance involved in checking all the boxes and making sure that they're on the right side of all the various money laundering and, know your customer. And, the Canadian LPs would have to think through their traditional banking relationships up north, and would those traditional banks allow them to have access? So there's a lot of complicating factors. This is not a straightforward answer, and it's not one party or one entity or one exchange that probably is going to set this free prior to federal legalization. It'll take a few different groups to all be coordinated.
Yeah, certainly a complex problem. You're absolutely right. And in the Weedmaps analogy, I mean, not plant touching, and maybe it's just easier for the lawyers to get comfortable with it. But yeah, here's
critical for sure.
Yeah, definitely. Well, here's to hoping, because I know that would change the dynamic quite a bit for these U.S. companies that are publicly listed.
Yes, it would.
Well, great. I think it's a perfect spot to end it. Jamie, can't thank you enough for joining. Congrats on everything with Air. I know we didn't touch on the earnings, but I know the numbers looked really good, and you guys had some great, quarter-over-quarter growth. So congrats there, and congrats on the announcement with Levia brand there. Excited to see that, and hopefully get to Massachusetts and try it, or maybe one of your other states once you guys roll it out and market. And as always, thank you, Emily, for joining. And it's my favorite conversation of the week, and looking forward to it next week.
Thank you both.
Sounds good. Thanks for having me.
Thanks for listening to the High Rise Podcast, presented by Headset. For more information on Headset, visit headset.io.